Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, hit the like button, and share these videos. This is the final week of the month of April. We've certainly seen a lot of volatility, but mostly upside movement as the markets have continued to recover. The fundamentals remain absolutely disastrous. Meanwhile, the Federal Reserve and the government continue to do stimulus and pump money and buy assets, supporting the market. I talked to you several weeks ago about the black hole. They're continuing to fill up that hole in the economy and causing basically a debasement of the currency itself. The Fed's balance sheet is pushing towards 7 to 10 trillion, and we're going to hear from the Fed chairman on Wednesday, as the FOMC meeting will be held on Tuesday and Wednesday. Market participants will probably buy into it, but the risk is that by Wednesday we could be printing up toward the 200-day moving average, and we could see a reaction from that level, since the anticipation by market participants have been so strong over the last several weeks. I've mentioned before that everything I do in my analysis is data driven, and our short-term models continue to get traction. We saw 1,822 new buy signals come in again this week, pushing the short-term models to a bullish percent of 45.7%. Anything over 42% suggests there's a sustainable rally unfolding, telling us that markets are going to continue to have an underlying bid. Now, our intermediate models do not confirm that. They are still saying that the market's in this larger sideways trend, representing what I've been talking to you for a while of that zigzag pattern. I will go through this in detail in the technical section here shortly. But as we look to this week, we've got plenty of news coming out, PMI and manufacturing news, but everybody knows these are going to be terrible numbers. For the most part, all of this stuff is priced in, and we're not likely to see any reaction around that. Everything's going to be centered on Powell's comments and the Fed statement that comes out on Wednesday. But the anticipation up to this meeting appears to be overdone. We'll find out. The models are telling us that the trend is going to continue, and it's not likely to end just yet. This new tranche of buys that I talked about in our database suggests we could extend this for another 2 to 3 weeks. This sets the tone for more traction in our intermediate models, telling us that this market is trying to set up some sort of bottom. This week being the end of this month, there's going to be a lot of position squaring ahead of the main numbers I talked to you about. Even though expectations are for the April numbers to be terrible, there's some likely surprises. We're starting to see some states come back online, but they're not states that have a tremendous amount of economic activity. Until we get the major population areas of this country back online, we're going to continue to see a deterioration of the backdrop of the fundamentals. Make no mistake that the Fed will be telling you they're going to support everything, and they will do just that. While that stimulus is definitely supportive, the problem is we still don't have the income, and there's likely to be further disruptions as we go down the line. My expectation is that the economy will not just go back into a V bottom and everything will be back like it was before. There's going to be too many business failures to deal with, and the Fed is going to have the tough decision of figuring out who the winners and losers are. That's going to be part of what we'll see going forward in the next 3 to 6 months. It will be some time before we find out if the stimulus, the Fed backstop, actually really saved the economy. Until then, we'll continue to rely on the technicals, which are positive, telling us the markets are likely to continue to expand. Let's take a look at the charts and see what our expectations are for this week. Beginning with the E-mini futures, there's a pattern that I've been discussing over the past several weeks, expecting this zigzag formation. I also talked to you last week that I did not think there would be any 5-wave configurations off of this bottom. Now, this daily chart is setting up the potential for a 5-wave pattern. First, let's discuss the pattern I've been talking about, this ABC setting up. My expectation was for a minor ABC with a pattern looking like this. Now, the PPMs are still not responding. This is the future, so it reflects the current upside of 0.5%. So they're not reacting, which says that there is still a possibility of a failure. This is one of these events where this pattern will not be negated until the high at the 2875 level is penetrated. At the moment, we're still setting up that right shoulder, so this is a pivotal point in the charts to determine the direction of movement. I talked to you earlier about our models getting more traction on a short-term basis. The probabilities are pointing that we will challenge that 2875 level and possibly get through it. But until that happens, this pattern will not be confirmed. So let's take a look at the probable pattern that could unfold here. As I mentioned before, I did not expect to see any five-way patterns. So instead of the ABC, this could set up as 1, 2, 3, and then this would be a wave 4, and then there would be a 5-wave up, which would head toward this 2997 level. It's 3,000 on the S&P cash. But this suggests it's going to continue higher. There's several other elements that are still positive. Even though the PPMs here have broken through their first and second derivatives in some cases, the PPM1 is still a positive 0.31, PPM2 is a positive 0.42, and PPM3 is turned up and sliced to the upside of its first and second derivatives. I've been discussing this pattern as it unfolds, and it continues to be very dynamic, and based on the activity in the database as well as the technicals here, this tells us there is a 60% probability for the 2875 level to be penetrated. If that occurs, then the backside of this 200-day moving average will be tested. I will be able to calculate what the projections are for the upside once we get that confirmation. The intermediate charts continue to have a negative element with the PPM1 still down 1.92%, suggesting that the market wants to correct back toward the 200-week moving average, which is that 2656 level that I've been discussing over the past several sessions. Looking at database, output, and some other elements, we're likely to see this penetration of 2875 and a continuation. If that happens, then what you're going to see from the intermediate charts would be an extension this week where this bar would extend up and would head towards the 21 and 40 period moving averages. Expectations are still for this large zigzag pattern to unfold. If we do continue to extend this up to the 30-30 level, then the next decline is likely to come into these levels here, maybe potentially at the 24 to 25 levels that I talked about last week. And then we would see more of this pattern unfold. And typically what will happen here is that this pattern will hit some resistance, go just above the 2875 level, print up toward 3,000, and then get a reaction. Now, when I was talking about the database on the opening comments and reference the database, those 1,800 new buys that came out were on individual symbols. So some of these symbols look better. They may not be the symbols that are going to drive these indexes. When I discuss our database, it gives a reference to what's likely to happen from a strength standpoint, but those are 1,800 individual symbols that issued buys. So there's going to be a lot of dynamics that occur in the markets. Even though we're seeing that kind of buying on the short-term models, it does suggest that we could trade into a sideways range at a higher level and still do that corrective phase and not kick out some of those stocks. As we go through the next several days and weeks, I'll continue to try to bring you into the world of the database that drives my software company and drives all of our quantitative analysis, so you'll understand this. So be patient, keep following, so you'll understand exactly what the configurations are and what the expectations are. As I mentioned in the opening comments, the intermediate charts are not going to issue buy signals, which suggests we're likely to continue in this choppy sideways range. Let's review the crude market as this continues to be in the news. The June crude is trading down about 9% at 15.47. This chart is a long ways from forming a bottom or any kind of sustainable rally, so it's likely to continue to grind. A couple of weeks ago, I introduced you to the VPM rangefinder, which estimates what the ranges are likely to be. For this week, the crude oil is projected to trade between 14.62 and 19.26. The extreme for this week on the downside will be 12.03 and the upside 21.85. Most likely it will trade towards the downside, not the upside. As you can see, the PPMs down below here have massive amount of downward pressure. This suggests as the weekly moving average moves down that it will put a cap on this market somewhere between 21 and 18. The final market will be gold. The configuration in gold continues to be very unorthodox. The pattern that I discussed a number of weeks ago was that we're experiencing a 1-2-1-2. The configuration suggests there's an alternative pattern that is likely to come out of this. So this 1-2-1-2 pattern in this area here, what occurred there was a simple correction. What we could get here to make this second leg different, we could get a more complex correction, which would come into this moving averages, then it would rally up. Now, the pattern suggests that we cannot take out this low over here. If it were to take out that low, it would negate the whole pattern. The next leg up on this market is likely to be substantial. The intermediate graph suggests that it's possible that gold could reach the 1787 level and possibly move above 1800 with targets of 1815 to 1839. This market could be stimulated substantially from this week's Fed meeting if the perception is that the Fed's activities will become highly inflationary. This will complete tonight's broadcast. Thank you for watching. We'll talk to you tomorrow night.